The more we learn, the more we earn. Today, now, over the next couple of weeks, is the perfect time for us to learn about the stock market. Get our feet wet. We got time. One Up on Wall Street is a book written by Peter Lynch. Let's jump into it. The first thing that Peter Lynch explains to us is individuals, investors, such as ourselves, can beat the pros. The reason we can beat the pros is because we're using our own money. We can go with what we feel. We can go with what we know is a good product. With that being said, if you like a product, you'll love its stock. We know way more about a product than Wall Street does. We use these products. We know in due time, if everyone else finds out about this particular product, that we love it as well. So let's invest in it while it doesn't cost a whole lot. When everybody else catches on and want to buy into this stock, we'll already be ahead of the game, seeing profits. He gives us a helping hand, but first he wants us to be financial literacy. He says that investment is broke down into 6 categories. You have your slow growers. These are your major companies. They bring in good dividends. These are your OGs. They've been around forever. Not a whole lot of money, but it's steady. You have your stalwarts. They usually bring in about 10 to 14% every year. Whenever you see one of these companies spike up 30% or more, Peter Lynch says sell it because it's going to adjust itself in just a short amount of time. You have your fast growers. These are your young bucks. These are your new companies. They pop in. They make mistakes, but until they make a mistake, they usually bring in about 20% plus a year. Jump on them. Cycles. Now, these are just like any other stock. They go up and down, but these go up and down with certain seasons. Let me give you an example. They make a new model of the same car every 3 to 5 years. Let's say 5 years. On 4.5 years, you'll see that stock go up because the new model car is about to come out. 2 years, that stock starts to trend downward because everyone has the car, they seen the car, they see the car, everybody seen the car, everybody has the car that was gonna buy the car. It starts to ease its way down. But just as soon as the new model about to come out again at another 4.5 years, the stock shoots back up. You have your turnarounds. These are companies that had a problem. They might have made a mistake. They might have had a couple accidents, an incident report. They had to go back and fix some problems that they had made. And everybody sold their stock and jumped off of the company's bandwagon because they had some problems that they needed to address. Well, these companies have addressed their problems, and now they're back in the game, and they're on their way back. Companies. These are companies that I like myself. Asset plays. Now, these are the companies that has money coming in more ways than one. They own real estate. They have subscribers. They have patents. They have natural resources. They have a long extended credit line, which is very important in the stock market world. These are your 6 investment categories of each stock. Now, he gives us 10 things that he likes to look for. Make your own decisions, but this is just Mr. Peter Lynch. He says he likes for the name to be boring or stupid. He said people usually overlook them. Good investments because they didn't like the name. He said it's something boring. Again, going back, they didn't like the name, so they looked over that it was a great company. It does something disagreeable. It might be a company that does cremation. Everyone doesn't agree with cremations, therefore, but it still might be a great company. Think with your pocket, not with your heart. Not on the radar. That means that the major people haven't seen it yet. You might be ahead of the game. The company might be depressing. When I say the company is depressing, it might be a funeral home, but they might make, or a company that make caskets. Caskets seems to be not on everybody's top of the list of things, so it might be considered as depressing, but it might be a great company. The industry that it in isn't growing. He said he likes company has a niche, something about that company, and they have a certain group of individuals that shop with them already. He said he likes reoccurring revenues. He said he likes insiders are buying this company and nobody knows about it. They buy their own shares. Now, this is a key point for me. I feel if a company believes in itself, they will buy their own shares. He also gives us 5 things to stay away from. He said he doesn't like the hot right now industry. Now, don't get me wrong, Peter Lynch is a billionaire, but there are some hot right now companies that you might want to dibble dabble in. Never know what can happen. It's the next something, meaning it's like the next Google or the next Yahoo or the next PayPal or Amazon. It's a bunch of companies that want to be next, and next might be so far down the line that it takes forever to catch up. But go back to the beginning. If you love it, if you like it, you'll probably love its stock in the long run. Now, he said he likes to stay away from companies that buy unrelated shares in other companies. He said he doesn't like companies that depend on one customer. If the only customer they have is the military, but they have a competitor and the military doesn't want to be with this company anymore for whatever reason, and they leave, well, the company has nothing else to fall back on. And he said he doesn't like companies that claim miracles. Meaning if they have one pill that cures all, they have a special ointment that fixes anything, they have a bean that you plant in the ground and it makes life just better. He said he'd like to stay away from those companies. He said because a lot of the time they're either misinformed or just plain out lying. Quick rundown. Peter Lynch went up on Wall Street. We are better than the pros because we're investing our own money. If you like a product, you'll probably love its stock. The 6 categories of investment: your slow growers that bring good dividends, your stalwarts that bring in 10 to 14%, sell at 30, fast growers, 20% a year on up, they go up and they go down, catch them on the curve. Your turnarounds, they had a problem, they fixed the problem, they back in the game. Asset plays, they have other ways of making money than you see. 10 things that Peter likes to look for: a boring name, a boring company, a disagreeable company, not on the radar, depressing, the industry isn't growing, has a niche, they own people already, reoccurring revenues, they make money every year, the inside people are buying it, and they buy their own stock. 5 things that he suggests that we stay away from: the next something, a company that buys unrelated shares, A company that depends on one customer and companies that claim to do miracles. Thank you all. Be safe. The more we learn, the more we earn. Take advantage of this time to learn how to make some money. Subscribe, like, and share. It's enough to go around for us all. Thank you.